Hello and a very warm welcome to ICICI Direct and Moneycontrol present Path to Financial Freedom. In this special podcast, we are joined by Pankaj Pandey, Head of Retail Research at ICICI Direct. First off, Pankaj, thank you so much for your time. As they say that in life you are always reviewing your performance of the last year and then making newer goals, I think that stands for financial goals as well. And if we were to start our conversation with short-term traders and what they are doing, how important is it for them to analyze their past performance? Why does it become so important at this point in time?
Thanks, Mugdha, for having me. So whether it is a stock, whether it is a economy, or whether it is a sector, everything goes through a particular cycle. Now there are broadly four phases of a cycle. So you'll have one cycle where the accumulation phase will happen. So that is where a lot of value investors will start chasing a stock or a sector,
Right.
and they'll sort of buy it over a period of time and not necessarily sort of chase the prices higher. So which is why they'll spread out their investment over a period of time. And this is a phase where bulk of the accumulation of the stock or a particular sector happens. And you will not find too much of a news in terms of why this segment or stock has been sort of picked up. At least not in the main media you will get. But what happens in the phase two is the markup phase. So this is a phase where the news flows starts to sort of start trickling in. That is where you see the maximum run up in the stock. That is where the technical breakouts also happen.
Right.
And that is where the maximum momentum also happens, and which is why it is extremely important for traders to sort of understand the overall cycle of the market. Then once this breakout has happened, what typically happens is that you get into a distribution phase. So that is where probably even if there is a positive news flow in terms of a company bagging order, you really not see or you will not really find the stock sort of making new highs. So it gets sort of slotted in a certain range. And while the volumes will go up, but when you look at the early investors or the value investors, whoever has bought that particular stock, they start to sort of tend to sort of book profits. Since it's a sort of a distribution phase, you will see volumes, but a very limited price action. And once I think everything is sort of priced in, that is where you see the markdown happens. And that is where you will see that 200 levels of exponential moving average getting breached. And that is how things sort of pan out. Now, to give you some examples, so for example, you look at a typical segment or a sector like commodities. Now, in commodities, the best sector or stock is something which has got the lowest cost of production. So, in a commodity, for example, a commodity like steel. Now, if you are sort of saying three players, be it say Tata Steel, then you have JSW and you have SAIL. Now, in a steel cycle, typically what happens is that the best company is the whichever is the lowest cost producer. So in this case, it is the Tata Steel or JSW Steel. But when the cycle sort of starts to turn, because what happens that when your demand is more than the supply, that is when the prices start appreciating, right? That is where the momentum also happens. Now, it is extremely important to understand which stock is going to deliver you more returns. So, for example, if your HRC prices are at 50,000 rupees a ton and prices move up by 5,000 rupees, right? Or 10% price appreciation. So, for example, for a company like Steel Authority of India, their average EBITDA per ton would be about 5 to 7,000 rupees per ton. Whereas for Tata Steel, it could be about 15,000, and for JSW, it could be in the range of say 10 to 12,000 odd.
Right.
So the maximum appreciation is going to happen in a stock like SAIL, not the best stock, which is Tata Steel or JSW. Because the delta, what you see is nearly a 60-70% kind of a jump is what would be expected in a company like SAIL.
Right.
But when you are in a distribution phase, that is where the shift needs to happen. Because when the markdown happens, the maximum beating the stock which is going to take is, it will be SAIL rather than Tata Steel or JSW Steel. So it is extremely important to sort of understand and slot stocks specific to the cycles.
So the next question then is how often should you be rebalancing or reassessing the portfolio and also looking at adjusting the allocations based on performances?
So I think one common mistake what people do while doing portfolio allocation is that they typically look at the price performance historically. So if a sector or a stock has done well, say 60-70% kind of appreciation you have seen, then there is a tendency to sort of rebalance the portfolio. I think that is where the challenge lies. I think typically our sense is that when you are sort of rebalancing your portfolio, it has to be done more from the outlook perspective
Right.
and also from the valuation perspective. So for example, if a particular stock, say, spends 95% of the time in a certain, say, PE multiple band, so whenever these levels are breached, that is when it should trigger a rebalancing in your portfolio.
Okay.
Unless we want to believe that there is something which has changed fundamentally in the stock. Otherwise, just historically, if you are sort of balancing your portfolio, see, there are two dilemmas. If you are sort of balancing it very frequently,
Right.
the challenge is that you will lose out on the returns. And in case if you are sort of doing it very late, then that means that your portfolio is going to be very volatile. So understand this in a cycle like say 2003 to 2008, your mid caps and small caps did 9x kind of a return, right? With this kind of a return, if you are balancing your portfolios very frequently,
Yeah,
then you
you're
are
not making.
literally missing the bigger picture.
Correct. Yeah.
So which is where I think a balance needs to be there in terms of your portfolio, and it should be more of an outlook based approach rather than sort
Rather
of
than
just
historical.
because. Yes,
Also, why fix something that is not broken?
absolutely.
All right. How do we identify the right growth stocks for next year? I mean, that is one question that everybody has in mind about the weightage on short-term, short-term performances and short-term trading in their portfolio as well.
So again, you can look at cycles. So sectors of stocks where we have seen more of a price correction and time correction, I think those are relatively better to sort of
Short-term trading.
yes,
Area.
because so for example, look at a sector like say cement. Last 1 year, we have seen the prices are at a 1 year low. Then there is M&A which is going on in the sector. The bigger players are acquiring smaller companies. And it is expected that your top 5 players will control about 60% of the kind of a capacity. And if you look at last quarter was the worst quarter for cement companies. So despite that, when the prices don't fall, which
Yeah.
again is a sort of a classic sign that worst is already factored in the prices. And now what you sort of tend to hear is that incrementally there has been an appreciation in prices. Now whether that holds or not remains to be seen, but from a time and a price correction, that looks good.
In this, practically, you're also looking at the historical performance and you're looking at the outlook, and yet you need to play safe.
Absolutely, absolutely. I think banking is also another one big sector.
Yeah.
Hasn't done much despite all the heavyweights, and you have it's a fairly large sector with all kinds of challenges. So earlier you had issues in the credit card, then microfinance. Now again, outlook based.
Correct.
So obviously now what is expected with the recent RBI policy is that possibly in the month of Feb or subsequent policy meets, a potential rate cut is obviously expected. Now, while it is beneficial for NBFCs first, but obviously it helps banks also because it overall lifts the overall economic activity.
Right.
So which is where it is beneficial for banks.
All right. Let's talk about sectoral ETFs and international stocks. Where do you see that in the whole portfolio diversification?
So there is always a saying that there is some bull market in any part of, or some part of the world which is
Correct.
always going on.
Yeah.
Right. Now, the thing is that if you can't really identify a particular market or a sector or a stock, then ETFs are one of the best ways to sort of approach that opportunity. So, for example, when you look at, say, in India, you will have a lot many PSU banks, right? And all of them are more or less
Correct.
similar business profile,
Performance.
but the sizing would be different. And even valuation wise, you will not really find too many variance in terms of their valuation parameters. I mean, except for SBI, which might be trading above book value, most of them trade below book values. So if you can't really figure out which one to sort of buy, then sectoral ETF is one of the best options to look at. So you'll have a bank ETF which will, or PSU bank ETF, which is what one can look at in terms of exposure.
We are also hearing so much about green energy and AI, and that is the talk of the town, whether in the markets or in the business arena. Every business leader is talking about it. The technology is changing. People are talking about it. Where do you see the emerging trends in these two industries?
So yes, I think a lot of people can correlate if you look at the kind of social media consumption we are
Yeah.
doing. I think the kind of data which we are consuming is enormous. And if you look at with this AI, what is expected is that see, a simple AI query requires 10 times more power than a normal Google query. And with
Yeah.
data localization norms kicking in, it is expected that the whatever digital footprint we generate should reside within the country. So from that perspective, this is giving a new sort of a segment, or there is a new upcoming segment in the market. So while you are sort of consuming data, especially a lot of social media, then what is also leading is that when you are sort of doing a data localization, you need to have a data center also. Our data center requires good amount of power,
Yep.
and it's not with India. Even if you look at a big country like US, so from that perspective, power is again becomes very
Becomes a good
core
sector.
to data centers getting created. And which is why I think when you sort of look at, or when you sort of connect the dots, then power becomes a very important sector.
Yeah. All the ancillary sectors
Absolutely.
become very
In
important.
fact, besides power generation, it is transmission and distribution which becomes the key, because when
Yeah.
you are putting up a data center, the it's a very concentrated power requirement which comes up.
True.
And not only India is sort of seeing
Yeah.
or overall the scope for transmission
Correct.
and distribution is fairly high,
Yeah.
not only in India but globally.
And they also want to be the manufacturing and the data hub. So, we are seeing these sectors sort of see a lot of traction.
Absolutely. And I think there is a global shortage of transformer capacity which is there, not only in India but globally as well.
That brings me to risk management. There are trends, there are very encouraging trends as well. There is a lot of temptation, and portfolio diversification, of course, then becomes about picking the best that is available. But when we talk about risk management and assessment, going into 2025, what would be your tips to anybody trading or investing in the markets? And also, perhaps a key message that they can take home with them today as they're listening to you.
So, in terms of risk management, a lot of things can be undertaken. So, one obviously is that ahead of any particular event, it is strictly not advisable to sort of have a very loaded position, because we have seen that whenever you have election results outcome, you see a good swing in the market. So that is one way to sort of avoid. The other is usual diversification. So again, you could sort of do a asset allocation across asset classes. So equity can be a core component, but you could have debt and you could have gold. So gold has been a sort of a very excellent hedge over a longer period of time. And within equity also, you can sort of diversify between large cap, mid cap, and small cap. So understand this, typically every year you will see large caps correcting 10 to 12 odd percent. But if you are having more of, say, small caps, the tendency of the small caps to correct by, say, 25 to 35% is fairly high. And it can
Right.
happen for various rhyme and reason every year. So that is one of the ways to sort of diversify. And I think one more thing is that leverage is something which people should be very conscious of, because if you are taking too much of a leverage position, especially ahead of key events, then I think it's a sort of a big challenge
Right.
which you are sort of getting into. So I think these are very simple and approaches to sort of risk management. And again, it's better to sort of diversify, because
Yeah.
and diversify across sectors if you are there in equities only. Because see, the fortunes of sector change over a period of time.
You've seen that for many, many years.
Absolutely.
Parting thoughts?
So I think overall, so we are expecting 2025 to be a reasonably better year. See, while we have seen that the earnings growth in the last quarter has not been really great, but if sort of strip out the commodity leg, so then the earnings are not so bad, which is what the narrative is usually at this point in time. And structurally, I think India is one of the best places to be into. And I will not be surprised, probably may not the same quantum kind of a return, because see, 2003 to 2008 was the best period for the markets. And during those periods, there were two strong cycles which were playing out. One was the real estate, and the other one was capital expenditure. We see similarities now also. Not saying that we are going to see those kind of returns, but never book out early.
Okay, that's a good one. And thank you so much. With that, we are wrapping up the show. But thanks for all those insights and, of course, for your time, Pankaj.
Thank you so much.
We hope these strategies empower you to make better investment decisions in the year ahead. Thank you for joining us.
ICICI Direct and Money Control present Path to Financial Freedom.